Hey, Devin Murrigan, hello to you. It's been a busy evening of business news. Many people waking up to the news, I'm sure, of the downgrading of South Africa's credit ratings. Let's bring them up to speed with where we are this morning.
Yeah, and Gareth, it was a bit of a surprise to have both rating agencies go straight into a downgrade. I mean, we never expected Fitch to give us this downgrade, and many economists and analysts before this evening or before last night assumed that perhaps the rating agencies would wait until the February budget and see what strategy is in there before they move on any rating action. It wasn't to be. Both Moody's and Fitch felt that our finances are not in order, and in fact, echoing through both reviews, they say that the reconstruction and recovery plan seems unlikely to be implemented significantly. Remember, this is a plan to rescue the economy that's been impacted from COVID-19 and from choices before that. So what does a rating agency do essentially? It basically assesses the country's ability to pay back its debt. And by the looks of it, where we are sitting with the junk status, Moody's taking us 2 notches below sub-investment grade. Fitch tells us we are 3 notches below sub-investment grade. They're basically telling us that our ability to pay back debt is quite precarious. And that's a problem, because all it does is that it makes our cost of borrowing even worse. So let's bring in Suvershan Pillay from Credit Ratings Analytics for more insights on the latest downgrades. Suvershan, thanks very much indeed for talking to us. Was the rating action, as far as a downgrade is concerned, not even just an outlook change, was it harsh?
Good morning, Devin, and thanks for having me on. Yes, I would concur that it is harsh, especially a double rating downgrade. But I mean, the rationale from the rating agencies is that the downgrades that came due at the beginning of this year was in relation to previous deterioration of the country before COVID-19. So what they've indicated that this round of downgrades was in relation to the effects of the COVID-19 pandemic on the economy specifically. But yeah, it's a bit of a harsh time, and especially with the economy being kick-started, and it's pretty much the worst time that this could come about. Especially with the president trying to get those a bit more investment into the country and stuff. I mean, it's not the ideal time, I would say.
And that's quite an interesting point, because here you have the president wooing investors last week with the hope that more investment would come in, churn the economy. Once the economy starts moving, we've got more taxes being generated from both new workers being employed and businesses coming up. But now you have a situation where investors kind of look at your score sheet and tell you you're not worth lending money to. So I suppose what happens then is that all they do is increase their interest rates. That's the last thing you need when you have a debt burden on your hands, is it?
Yes, no, you're 100% correct, Devin. I mean, in terms of our interest borrowing costs, obviously increasing at around 16%. We're borrowing about 2.1 billion rand per day. I mean, it's not the ideal thing, especially if you're looking at an economic turnaround. It just results in the government having less funds available to allocate towards economic stimulus or socio-economic benefits to people of South Africa. So, yes, I mean, it sort of adds to the negative trajectory that we unfortunately are on at the moment.
Looking at those publications yesterday, and both Fitch and Moody's echo one theme, I think, that stands out in the middle of all of those words. They are not convinced that the reconstruction and recovery plan could be implementable, because they say the track record in this regard hasn't been one to sort of scream about and celebrate by the South African government. And that plan ostensibly is the blueprint for getting this economy back in order. I'm wondering, what does the government and all other stakeholders do from this point? Because it's very difficult, history will tell us, to get back into investment grade, and we look like we're further and further from that line.
Yes, you are correct again, Devin. So, I mean, it probably comes down to action now. So how does the government, I think we've got to do away with the talking, and we've obviously got to implement the action and show them that we can obviously implement this plan. So, I mean, it's probably between now and the tangible outcomes starting to come into effect that we are going to start impressing the rating agencies again. And I mean, yes, it's in terms of getting back to investment grade, That's obviously the most important thing that we need to focus on, because that obviously increases our investability. So in terms of these foreign direct investment drives, it's obviously going to enhance our chances of securing those investments and bringing it into tangible outcomes. But I mean, yeah, just in terms of getting back to investment grade, so that's going to be a tough task by itself. I mean, on average, for non-European countries, you're looking at about 8 years to get back to investment grade. And the funny part about it, man, or the interesting part about it is that once we dip into the single-digit B category, then that sort of deteriorates our chances significantly of getting back to investment grade. So to put it into perspective, probably over the last 30 years, the 10 countries that have lost their investment grade rating and got back to investment grade, 2 of those, well, 8 of them stayed within the double B category that we are now on the borderline of with Fitch and S&P. The 2 countries that slipped to the single B category, it took Indonesia about 20 years to get back to investment grade, and it took Uruguay about 10 years to get back to investment grade. So we sort of at that borderline level of the double B category, which is regarded as the speculative. And if we move further, we'll move into the highly speculative. And obviously, there would be a significant increase in borrowing costs and stuff if that was to transpire.
All right, we're going to have to leave you there, but thanks very much indeed for your insights. Servesh Pillay is from the Credit Rating Analytics Group.